You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello. Thank you for being here today. Well, the day has finally arrived where I get to share with you the fun topic of fractional reserve banking. I know that you're on the edge of your seat just waiting to begin. So what is fractional reserve banking, you must be thinking? Well, what it is that banks are literally making money by creating money out of thin air. Well, that's not very comforting now, is it? But this counterfeiting is what we call fractional reserve banking. Now, what that looks like is that banks are only required to keep a fraction of your deposits on reserve and are able to loan out the difference to borrowers. Except actually, they can loan out multiples of those reserves that they are required to maintain. Now, let's reflect back to the story of the bankers in my last episode, where the goldsmiths, or more like the first bankers, realized that they could lend out up to 85% of the coins that they had in their vault, because the customers who own those coins never withdrew more than 15% at any given time. So those original depositors, they had received paper receipts for the coins that they owned in the banker's vault. And now the bank was issuing loans in the amount of 85% of those coins. So what that did was it made 85% more paper receipts than those bankers had in physical coins. By doing this, these bankers created 85% more money, and they were able to put it into circulation through their borrowers. I think most people know that if everyone went to the bank at the same exact time to withdraw all of their money, that the bank wouldn't have enough money to meet all those demands. I think everyone knows this or has it in the back of their mind. Well, and this is why. And this example is really actually nothing like what is going on now. So that was a baby example compared to what's going on now. And then when we think about, people will think, but there's FDIC, so we have nothing to worry about. They're comforted by FDIC. They're going to protect my deposits. But if you know anything about FDIC, they actually have less than 1% in reserves for the deposits it insures. Does that amount, less than 1%, make you feel that your deposits are safe? Because it doesn't make me feel safe, let me tell you. And where are they going to get more money to be able to insure or have in reserve more than the 1% that they are saying that they're insuring? They're telling you to be confident, they've got you, or they have all the money that they need to protect your money, but they only have less than 1%. So if they need more, well, they're going to have to go to the taxpayers because the government doesn't earn money. So in order to get more money to protect more of your money, they're going to have to take more money from you in order to protect your bank accounts the way that you're expecting that they are. And that's why I put nearly all of my savings dollars into whole life contracts. I don't even have a savings account at a bank. As my earnings go up, so do my whole life premiums, because I would rather house my money with a company that is not doing this fractional reserve banking. So if you haven't read the book, The Case for IBC yet, I do strongly recommend that you do. It's very well written, captivating. It's one of my favorite books. I really enjoyed it. And it's short. It's not really super long. In the very beginning of this book, the authors explain what it means to be an unsecured creditor of the bank, and how once we make a deposit at a commercial bank, we are actually no longer the owner of that money. Now, let me just say that again. When you make a deposit at your bank, you are no longer the owner of that money. Is that a little scary sounding? Because I think it is. Because instead of being the owner of the money, we become unsecured creditors of the bank. In the book, it says, after the bank bailout of 2008, the Dodd-Frank Act was written because Americans were angry. And this new law clearly states that during any future crisis, taxpayer money is what will be used to replenish these bank deficiencies, meaning that there will be a bail-in. That means that the shareholders and creditors, the creditors being the depositors of the bank, will be the ones to eat the shortfall. Now, this has already happened in other countries. To read more about it, you should pick up a copy of The Case for IBC by Nelson Nash, Carlos Lara, and Robert Murphy. Okay, so I'm going to give an example of what fractional reserve banking looks like. This is information that I have on a slide that was created by Nelson Nash. Thank you, Nelson. But first, going back to the example I gave about the original bankers loaning out up to 85% of what they had in their vault. So nowadays, banks only have to keep 10% of the deposits they receive in reserves. For example, back in the day, if I deposited $100 into the Goldsmith's vault, they would have wanted to lend out $85 of that money. But now, if I deposit $100 into the bank can basically lend out $1,000. Again, making money out of thin air. They don't have an extra $900. They just type that right into their computer and poof, now they have $900 extra to loan out. Now, the slide that I'm referring to in Nelson Nash's original presentation is a rough example of what this process looks like to help bring clarity to you. For even more clarity, you can grab the book, How Privatized Banking Really Works by Carlos Lara and Robert Murphy. Now, I'm going to pull up this slide so I can talk about it here. So one thing though, too, just before I go into the fractional reserve banking, is that there is a colleague of mine that had some information. His brother worked at a bank back in the 80s and 90s. He was a manager, and they pulled information from their bank meeting that we now have, where he said, hey, this might be useful information. You might want to share this. And I'm just going to read what it says. It says, but savings are a vital link in our national economy too. In order for businesses to get started and for individuals to borrow for needed items, banks need money to loan. And the fact is, individual savings accounts like yours are a prime source of that money. Because of a multiplier effect, every dollar in the bank becomes $6 available for loans and investments. Now, this was back in 1992 at a bankers meeting at the American Bankers Association. And so now it's more like 10 times, like I had said before, not 6 times. Okay, so now this slide I'm going to go over an example that hopefully I can talk through in an understandable way. Okay, so you have $100,000 that you want to deposit at the bank. So you take it to the bank and they say, hey, great, we're going to give you 4% interest to leave your money here. So you deposit your money, you're going to get 4% interest, and right away, they turn around and loan out your $100,000 to someone who would like a new home for a mortgage. So those homeowners, they take the $100,000, buy their house, give the money to the seller. The seller turns around and puts it back in the bank. At the same time, somebody would like a car loan. They need $100,000. So the bank gives the $100,000 to someone else to buy a car. They charge that person 8% to borrow the money. The person who buys the car gives the money to the dealer, and the dealer puts it back in the bank. And then we have a third person who would like to remodel their home. And so the bank gives them your $100,000. They charge them 9% interest to borrow the money. Those people then pay the contractor who puts the money back in the bank. And a fourth example would be a couple who would like to do some debt consolidation. So they borrow $100,000. The bank charges them 12% interest. They pay off their credit cards, and then those credit card companies put their money back in the bank. So this is only 4 transactions, 4 examples, and I just told you they're doing this about 10 times. But in the first example, the bank is paying you 4%. They're charging the homeowners 7% to loan the money so they could buy a house. And so the bank made 3% more than they paid you in the first example. In the second example, who they loaned out your money so someone could buy a car, they loaned it out for 8%. They're paying you 4%, so they made 4% more than they're paying you. In the third example, they charge the house remodel people, they charge them 9% to borrow the money. They're paying you 4, so they made 5% more than you in that third transaction. And in the fourth, they charged 12% to the couple who wanted to do debt consolidation. So they paid you 4, so they made 8% more than you in that fourth transaction. So the bank made 20% in interest from loaning out your $100,000 to these 4 different people. So they basically did 500% better than you did. Okay, well, I simplified that as much as I possibly could and hope that it comes across as understandable. I do have this information in a visual slide, so if we end up connecting, I'd be happy to share it with you. Because of all of this that I went over today, this is why I want to keep as much of my money out of the hands of bankers as possible. I don't want them to inflate the money supply. I don't want them to be creating money out of thin air. I don't want to be a participant in that, and I don't want to be at risk for not being able to access my money when I need it or want it, or wanting to bail the bank out because they made bad decisions in what they did. I do not want to be the person bailing out the bank. No, thank you. Of course, it's pretty much impossible these days not to use a bank in any way. So of course I do have a checking account at a bank. I use it for all the same purposes you do for, debit, using my debit card for all those things. It's pretty much impossible to not have a debit card. I'm just saying that all my savings goes into whole life contracts with life insurance companies who again do not practice fractional reserve banking. Well, I hope this information was helpful to you in some way, that it was interesting, that you were able to understand more of this process. I do have a 3-page document by Murray Rothbard, who was an American economist, that gives a really great description of fractional reserve banking. If you would like a copy, please reach out to Valerie at alphaomegawealth.com. I would be happy to send it to you. Also, feel free to reach out if you would like to learn more about how the infinite banking concept could be something amazing for you and your family that you might be able to implement in your life. Thank you for listening. Next week's podcast topic is going to be about money that we are willingly handing away. And I will be sharing about money that is slipping through our fingers in the form of interest, and how instead we can start retaining more of that money. You don't want to miss it. Until next time, have a great week.
This is thepodcastfactory.com.